Hey everyone, welcome to the stream. My name is Boris. I'm a professional crypto trader and analyst. With this stream, what I really wanted to do is give an introduction to trading crypto for traders who are perhaps already familiar with the Forex and equity markets and kind of give just a brief intro, or actually not a brief intro, but actually quite extended intro on trading cryptocurrencies. So part one of this series is going to focus on volatility, liquidity, and market dynamics. And I believe it's going to be a multi-part series where I will really be going on a deep dive into all the nuances of trading cryptocurrencies. But for this session, we will be focusing on just the first part, which is volatility, liquidity, and market dynamics. So let's get started. So I started with volatility because I believe as traders, that's what we're looking for to make our profits, to make money. And the good thing is in crypto, there is very high volatility, which is why this is the market I prefer to trade for most of my swing trading as well as my intraday trading. So with volatility comes sudden extreme price swings, potential for high returns, but also high risk. And some factors that do contribute to the volatility in the cryptocurrency space are, of course, the limited age of the market. So Bitcoin was incepted or it was created in 2008 or 2009, but it really didn't get listed on crypto exchanges until 2010 to 2011. So we really have only about maybe a decade or a little bit more than a decade of price history for Bitcoin, which is the longest running cryptocurrency so far. And then of course we have regulatory news. So this is a big thing in the cryptocurrency scene. So I'll give you guys an example. So earlier this year in June, there was an announcement by the SEC that they're basically suing Coinbase, which is the largest cryptocurrency exchange in the United States, as well as Binance, which is basically the largest international exchange by volume in the whole world. And that basically made the entire crypto market. It made the entire market take a huge nosedive. Many tokens and many different cryptocurrencies were down 15 to 20%. Some were even down as much as 30% when this announcement came out. And this even influenced the price of Coinbase stock, which I'll go on a little bit of a rant here or a little bit of a tangent, but I find it funny that the SEC decided to sue Coinbase when Coinbase, the company, the equity, actually went public back in 2021, I believe. And in order for a company to go public on the Nasdaq, where Coinbase is currently listed, you have to go through a lot of regulatory scrutiny. So it obviously passed all the regulatory tests back then in order to be listed by the SEC and by all other regulatory agencies in the United States to be listed on the Nasdaq exchange. So the fact that 2 years after that, the SEC decides to sue Coinbase for whatever factors are listed in the lawsuit, is I find it a bit ridiculous and feel like it's a bit of an attack on crypto itself. So yeah, that's a little bit of a tangent, but you have to watch out for things like these. So right now in the space, there's the lawsuit is still ongoing. So I do believe this is one of the reasons for the current kind of like sideways action we're seeing in the cryptocurrency space, or at least it's not sideways. Or I mean, if not sideways, it's definitely bearish to it's bearish to sideways, I'd say, and it really hasn't caught up to the movement in the equity markets, such as in the Nasdaq 100 and the S&P 500. So crypto and I'm sorry, I mean tech and the S&P 500 had quite a nice rally this year, but crypto just hasn't been able to keep up. Relatively speaking, I mean, Bitcoin did hit a high of a little bit over 30,000, but ever since then, it's been just kind of going sideways, been just selling off, just kind of like drooping down sideways to downwards, and not really seeing balance that we've been seeing in the equity markets this year. And when I say balance in the equity markets, I'm talking about the weekly to monthly time frames. So whatever is going on in the shorter term time frames, I'm not talking about that. I'm talking about so far this year. I think the equity markets have had quite an impressive rally, and we'll see. We'll have to see where it goes. Whether we've reached the top, or perhaps we're just seeing kind of like a pullback here, and then ultimately the equity markets will go higher. Yeah. So apart from regulation, uh, yeah, the cryptocurrency markets are driven by news, social media, and speculation. So I don't think this is too different from equity markets. Perhaps this is for sure different from the forex markets, but yeah, in crypto, it's definitely in terms of social media, especially when you think of like the altcoins like Dogecoin and Pepe and Shiba Inu. Those are the coins that are really driven by like hype and euphoria that you read on Twitter, or it's called X now, or Reddit, or whatever, whatever forums or whatever, I guess, social media sources you use to derive your investment information or trading information from. Which I don't advise, obviously, to take advice from social media, of course, but you'll listen to some like crypto influencer or YouTube influencer, and he'll say, "Oh, this project is amazing. It's gonna go up like 100x in this coming year," and that really does drive the hype and euphoria that we see in the market for some tokens. And then, of course, another factor that contributes to the volatility in crypto is just the lack of market maturity. So I actually think it's a good thing. So unlike stocks and equities, we have an absence of dividends and earnings reports. So unlike in stocks, we don't have to worry about uh, any kind of earnings reports or any kind of earnings calls where the CEO goes on the line and says some stupid stuff that ultimately leads the price of the equity downwards. So for most cryptocurrencies, everything is very decentralized. There's no CEO. There's no dividends. Well, it's a bit of a tangent, but in a way, if you do like stake cryptocurrency, which is more of an advanced concept that I could perhaps go over in later segments. But I guess that would be sort of similar to a dividend, but there's no earnings reports and there's no CEO for the most part, especially for the blue chip cryptos like Ethereum and Bitcoin. So what I've done with this topic of volatility is I've calculated the daily ATR, aka the average true range in crypto versus other assets. So I'm sure if you're already a trader, you're familiar with the concept of ATR. If you're not, just a brief explanation. Basically, the average true range measures. It's pretty much as it reads. It's the average true range of an asset. So pretty much measures the low to high from open to close of a given asset, and it just takes the average of it. So for Bitcoin, the ATR is on a daily basis. It's 2.51%. For Ethereum, it's 2.73%. For the US 500, 1.11%. For the Nasdaq, it's 1.57%. For crude oil futures, 2.14%. For natural gas, 4.75%. Gold's 0.75%. Silver, around 2%. And then the euro dollar is around 2/3%. Um, so you might tell me, all right, Boris, that's interesting, but who cares about Bitcoin and Ethereum volatility because we have natural gas, which is almost double the volatility of Bitcoin. Why should we trade Bitcoin when natural gas offers so much more volatility? And that's a fine argument. And then I would say, of course, Bitcoin and Ethereum are just the top two cryptos, but within the entire cryptocurrency market, we have I guess it's called the altcoin sector. Some people call it by other names, but we'll call it the altcoin industry. So apart from Bitcoin and Ethereum, we have Dogecoin that has a daily ATR of 3.33%, and then Shiba Inu 4.32%, and then Arbitrum which has an ATR of 5.34%. So now this is getting higher than natural gas. Then of course you have Pepe, which is kind of like a meme coin based on the that frog, which has an ATR of 8.31%. And then finally we have the one of the newer projects in this space, which is WorldCoin, which comes in with an ATR of 11.56%. So that's pretty awesome volatility if you're a trader, especially for WorldCoin. For those who don't know, WorldCoin was created by I believe his name is Sam Altman, who is the creator or the CEO of OpenAI, which created ChatGPT. So it's a pretty big project that's currently getting a lot of hype right now. So actually, what I want to do is I want to jump into TradingView and just show the volatility that we're experiencing in WorldCoin right now. So let me just uh, yeah, we'll go to different stage right now, and yeah, there we go. So we have WorldCoin right here on the 1 hour on TradingView. Quick example, guys. So we have this so this is just the hourly chart from last Friday, and we see a 1 hour candle where on an open to close basis, WorldCoin went up over 14%, and then a few hours later it's down 10%, and then down another 6%, and then I think today we had a nice rally. It was up 7%. So incredible volatility. If you're one of those traders that goes all in, all out with your entire capital, like you could make incredible gains with a tight stop loss if you just I don't know if you have some sort of strategy that makes you go long on this candle, and then the next candle gives you over a 7% gain, which is pretty incredible. So that's just a brief example. Let's go back to the slide now, and then we'll go on to the next slide. All right. So one important concept in cryptocurrency is liquidity. So this is very important in all markets, but especially the cryptocurrency markets. So unlike equities and forex, what differentiates cryptocurrency is the fact that we have 24/7 trading. So there are no opening or closing hours. Uh, you can pretty much trade anytime you want. So it's 24/7, even on the weekends. I actually did. I don't recommend it. I actually did do a few trades over this past weekend when I'm recording this, and I'll go over the nuances of weekend trading. But yeah, if you're a trader, if you're addicted to trading, this is awesome. You can, if you're bored on Saturday night, if you didn't go to the club and decide to dance on tables like everyone else, you could just stay home and just trade the cryptocurrency markets. So that could be a really great thing if you are a cryptocurrency trader. Next, we have decentralization. So there's no central authority that impacts liquidity distribution, and we also have global participation. So unlike stocks or equities where you might have to have like a certain account size to day trade equities. So I know in the US we have what's called the pattern day trader rule, or aka the PDT rule, which means unless you have an account size of over $26,000, you are not able to, or you are able to day trade, but it's only limited to 3 day trades a week, right? So in crypto we don't have that. You can do as many trades as you want per day. You can do 10, you can do 50, you can do 100 if you like. So there's no real central authority, and there's no kind of really regulations as it comes to like day trading. So that's a great thing, especially if you're based in the US, which has a lot of regulatory authority over especially retail traders, which is kind of weird because you'd think the US is the land of the free, but I think other countries are more free when it comes to trading. Uh, and then of course, yeah, we have yeah. So I think that's pretty much what I want to cover for the side. Oh, and in terms of like decentralization, when I say no central authority, so we don't have any kind of like central bank that dictates monetary policy that would ultimately affect the prices of the forex or the equities that you're trading. So that's what I mean by no central authority. And then yeah, for traditional markets, we're limited by the trading hours and days. So, if you're trading the equity markets, obviously it's if you're based in the Eastern time zone, trading the New York Stock Exchange, it's from 9:30 a.m. to 4 p.m. Eastern. And then there's some aftermarket trading, but from my experience trading the equity markets, like the after hours trading is the liquidity is pretty bad. Like I believe you can only get filled on a limit order, and there's no market orders after hours. Uh, at least if you're a retail trader like me. So yeah, outside of market hours, it's kind of very difficult to trade equities. But if you're trading crypto, the liquidity it's available 24/7, so there's no issue of getting filled at market price, even if you're trading at 1 a.m. or 2 a.m. in the morning or whatever time you're trading. Because like I said, it's a worldwide market, and there's literally market makers operating 24/7, 365 from all regions of the world, which is awesome. So of course, equity markets or traditional markets have centralized institutions. So obviously, central banks like the Federal Reserve and the ECB and all other central banks play major roles when it comes to monetary policy. And like I was saying in the earlier slide, there's higher entry barriers which require significant capital. So, and that was kind of covering the PDT rule that I mentioned earlier. So one thing I want to mention is just the overall liquidity environment within the cryptocurrency space right now. So for those who aren't aware, well, I guess most people should be aware, but if you're not, FTX, which was one of the leading exchanges in the space, went bankrupt almost a year ago, or in November of 2022. And with that came a lot of regulatory scrutiny and a lot of just a lot of like regulatory oversight that basically made a lot of market making institutions leave the space. So this graphic that I got from Glassnode, which is uh it's a really good website by the way, if you're trying to get like on chain analytics for different metrics of the cryptocurrency industry. This is a really great chart that focuses on the futures and options volume of Ethereum in particular. Now, I chose Ethereum here just because this is like the one free graphic that I found from Glassnode, and I think the same kind of pattern would apply for Bitcoin as well. So this chart basically measures the average derivatives volume for Ethereum going back since January of 2021. So we can see that yeah, basically the futures and options volume for Ethereum as well. No, just for Ethereum, but as well as Bitcoin. If we were to go look at a chart of Bitcoin for this graph, we would probably see a very similar thing. So yeah, ever since the peak back in mid 2021, we've basically been seeing a steady drop off in futures and options volume, and this especially became very apparent yeah, right around the collapse of FTX. So yeah, right now it's kind of like at a really the futures and options volume is kind of at a all-time low. And I do believe that that's probably as a result of many different variables. The first variable is of course the collapse of FTX and many market making institutions leaving the cryptocurrency space, such as Jane Street and Jump Trading. And then of course there's just a lack I believe there's a lack of interest for retail users in this space when you have all these AI hype stocks and all these psychedelic and cannabis stocks. that are currently popping off in the equity markets. Right now, there's really not much happening in crypto. It's just kind of going sideways from time to time. We do see an occasional rally or pump in some speculative names, but overall, it's been kind of a boring year. And I'm speaking as an as a person who has been swing trading and day trading this market since, I mean, pretty much the entire year. So you just take my word for it, guys. So before I go on to the next slide, I guess with the issue that we're having in liquidity right now, what I've noticed, especially when it comes to intraday trading, is that the liquidity isn't as good as it was even back in 2021 or even before really the bull market started for crypto and equities earlier this decade. So yeah, from my experience, this is just going from my experience, and I'll actually prove this with the next slide. Is that the liquidity of altcoins in particular has gone way down. Like it's you get like very aggressive wicks to the upside or downside, uh, like pretty much on any time frame below, let's say a 4 hour time frame. If you're trading like the 1 hour, especially on altcoins, it's the liquidity is pretty bad. Like it's very hard to get filled at the market price that you want to get filled at, and you'll notice that the price action is like very erratic. And so this is like talking about altcoins in particular. For like Bitcoin and Ethereum, for Bitcoin and Ethereum themselves, liquidity is still okay, especially if you're not going below a 15-minute time frame, which is the time frame that I personally that's like my limit. Like I don't go lower than the 15-minute time frame on Bitcoin and Ethereum. And as a rule for altcoins, especially like the more liquid altcoins, I try to stay above 1 hour time frame. So obviously this market as it stands today is not as liquid as the forex or equity markets where you can easily trade the 1 minute on the US 100 or on the euro dollar or whatever forex pair you prefer to trade. You just can't do that in crypto. I mean, I'm not saying you can't do that, but from my experience, I think it would be a lot easier to trade the 1 minute on the US 100 or on the euro dollar or the US dollar versus Japanese yen. So, and then one thing I'll mention as well is that on the weekend, if you do decide to trade the weekend time frames, the liquidity pretty much like really drops off by two to three times. So that's when like all the things that I said before about liquidity for altcoins and liquidity for Bitcoin and Ethereum that actually uh, it really starts to amplify itself. So perhaps on the weekend, I really would advise not trading on the weekend at all. But if you do, I would recommend uh, like raising your ATR of your stop losses and just giving more room for your trades to play out because the price action on the weekends tends to be very like flip floppy and kind of like just kind of like in the air, just kind of like not having any kind of real direction. Or if it does have a direction, it ultimately reverts back to what it was doing to end the week. So it's kind of like an um, advanced topic, like the weekend trading that we experience in crypto. But I think in the next couple of slides, I'll explain what really occurs over the weekends. So yeah, what I want to cover now is a liquidity report from I believe it's pronounced Kaiko or Kaiko, which is it's a cryptocurrency research firm, and they came out with some very interesting graphics recently that actually cover this topic in particular. So I'm gonna switch stages right now. So yeah, so what I really want to cover here is yeah. So let's talk about the percent change in crypto market depth, which obviously contributes to the liquidity issues that we're seeing within crypto. So basically, this research firm's order book data captures all bids and asks within 10% of the mid price, which lets traders explore the concentration of liquidity within various percentage ranges. And so they noticed that ever since the FTX collapse, the 0.1% market depth, which includes bids and asks within a very tight range, has recovered more than liquidity placed in wider price ranges. So basically, that means that market makers are supplying liquidity in a very tight range, which I think explains some of the very like sideways and tight price action that we've been seeing. But at the same time, when price expands above these ranges, that's what really I guess contributes to kind of like the extended moves that we see in the market sometimes, because basically the market makers aren't supporting price below like a certain specified range. And then this article goes forward, and this is pretty interesting because this chart explains the altcoin market depth of offshore versus U.S. exchanges, and so this suggests that essentially, yeah, U.S. exchanges have suffered a lot more than international exchanges because of regulatory actions, and as well as from the retreat of several big market makers, which I have mentioned earlier. So therefore, altcoin liquidity is at a premium. And then when you compare altcoin market depth on U.S. exchanges versus offshore, you'll find from the study that these guys did is that the concentration on offshore exchanges has increased from 65% to 71%. So there's a lot less liquidity on US exchanges. So I'm not sure who the target audience of the people viewing this stream are, but if you are on US exchanges, be aware of that. The altcoin liquidity, especially on US exchanges, has dropped quite significantly. And then, yeah, well, let's just read the conclusion here. So, liquidity as measured by trade volume and market depth is heavily concentrated on just a handful of platforms. Globally, there are hundreds of cryptocurrency exchanges, but many cater for just a niche segment of market activity. While it may be optimal from a market's perspective to have liquidity concentrated on just a few exchanges, the cryptocurrency industry generally holds decentralization in high regard. And when it comes to centralized exchange liquidity, there's very little decentralization. So, yeah, this is a really good report from Kaiko that really talks about the liquidity issues that we're seeing within just the overall crypto market. So, maybe I'll leave a link of this in the video description of this video. Let's go back to the slides for now. All right, so some little nuances that I want to cover within the cryptocurrency space is kind of funny. So, what you'll often see on not yeah, not even just Bitcoin, but pretty much all cryptocurrencies, you'll kind of see this Bart Simpson pattern that resembles Bart Simpson's head. So you'll see price rally or pump very nicely, and then it goes kind of sideways, and you'll think, oh, it's just consolidating for another leg higher. But no, what ultimately happens is that price completely collapses. It basically goes straight down, completely retraces the previous movement, and ultimately just does a Bart Simpson pattern. I don't know how better to explain it. So actually, to better explain it, I'll go back to TradingView. So I have a chart pulled up for you right here. This is Bitcoin on the hourly, and we have a very classic example of a Bart Simpson pattern right here. So this occurred back in June of 2023. Yeah, we get this nice rally in Bitcoin, go sideways, da, 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 then boom, back down, completely retraces the entire movement, and then yeah, a few days later, we see this on a smaller, kind of on the smaller scale, but nonetheless, we get this huge hourly uh, pump or rally in the price of Bitcoin. It goes up over 5%. I believe that this was based on the grayscale news that the market saw back in late August, and ultimately the market just completely retraced that movement following the SEC's announcement that it needs like further time to review the ruling or whatever the legal decision was. So yeah, be aware for this. From my experience, apart from being a cryptocurrency trader, I have traded the equity markets pretty substantially. So I don't often see this kind of price action in the Nasdaq 100 or the US 500. So very very strange, very very strange. So yeah, the Bart Simpson patterns. Uh, be aware of those. All right, let's move on. All right, I guess one more nuanced topic. Actually, there's a couple more, but let's talk about CME gaps. So, yeah, for those who don't know, this is actually a very unique thing in crypto markets, and I think if you actually know this concept, it'll really help you in your cryptocurrency trading. So, I'll go to my. Well, actually, first, sorry, let's define what a CME gap is. So, basically, a CME price gap occurs when the opening price of a new trading session significantly differs from the closing price of the previous session. So often what you'll see is for the CM if you're following the CME chart for Bitcoin, obviously the CME exchange is closed on the weekend. So basically what you'll see is that like the spot trading goes on Coinbase or Binance or whatever exchange you use for your regular cryptocurrency trading. But since CME is a futures exchange, it's only open from Monday through Friday, and then it reopens Sunday night, obviously. But what you'll see is that we do see price gaps on the weekend. So so the significance of this is that cryptocurrency traders often watch these gaps closely as they can act as areas of support or resistance. And yeah, like these gaps do tend to get filled at some point or another. So I think it's very important to watch out for this, and I'll actually jump it back into trading view and show you guys what I mean. So now what I'm showing is the CME chart of Bitcoin. Okay, so let's go to one recent example back in August. Um, so basically, the CME exchange closed on Friday at a price of $27,620, and then it reopened the following weekend at a price of actually this wasn't the following weekend. So one funny thing with the CME is that there's a 1 hour session break within the CME exchange. So I believe it's every day from 5 to 6 p.m. Eastern Standard Time or 4 to 5 p.m. Central Standard Time. And during this 1 hour period where the CME exchange was closed, the spot market actually continued to decline. And so it's kind of like a setup I had, I guess, pre-planned back when this happened, which didn't quite follow like the way I thought it would go. But essentially, I thought it would fill the gap, right? So it would fill the gap at $27,600, and then from there it would just continue going lower. But ultimately, if we continue going here, so price did end up filling the gap, but it actually went a little over this kind of zone I had. But ultimately, did if you didn't have too much of a tight stop loss and you took this kind of trade, you probably would have been okay, even dealing with this drawdown that you saw with the CME going with the spot price going above the price of the CME exchange. Nevertheless, you would have seen a more like if you would have stayed in the trade, price ultimately would have reverted back to the range, and then ultimately would have actually gone below the range very briefly. And I mean, if you shorted right here, this would have been. Let's measure this out. It's about a 9% movement from the gap to the recent low that we had in Bitcoin. So pretty good strategy, I would say. Keep this, yeah, keep this in mind. The theory of the CME gap. And then I'll try to find some more examples right here. So yeah, here's another one. So this gap occurred, and you can obviously back test this for yourself. Don't just take my word for it. So price closed on Friday, back in May at about 26,000. Let's call it $27,000 or so, and then it opened at 28, close to $28,000. So this was almost a $1,000 price gap. So does that mean you like start shorting as soon as you see this? No. What I recommend traders to do is actually wait till the gap is filled, and then depending on your view, you either fill the gap to long it or you fill the gap to go short. So in this particular example, I do believe what the best move was. The best move to do was to basically short this movement, and ultimately you would have seen a pretty nice drop of close to, from what I'm seeing here, 5 to 6% when the gap was filled. So keep in mind, like this, I guess, gap theory, it has to do with what are the overall market dynamics within the cryptocurrency space. So if if we're in the bearish trend, which I do believe we are in right now, and we have been in for the past year, really. If we get a gap to the upside, I would definitely favor shorting that move versus if we get a like let's say we get a gap down and we're already in the bearish trend, then perhaps that actually is the real move, and maybe I'll just go with whatever the CME chart is showing if we're going downwards. So yeah, you can basically just plot the CME chart on your trading view. The ticker is BTC1 exclamation point, and you can really see what I'm talking about if you really backtest this. Yes, let's go back to my slide here, and I'll finish off with my I guess my last thoughts for this first series of this many part series on cryptocurrency trading. So yeah, what I want to talk about is, so could crypto actually act as a hedge against macro risks? So what kind of macro risk am I really talking about? So I'm talking about what happened with the banking sector in the United States back in I believe it was back in April, when several large banks such as Silvergate Capital and then Silicon Valley Bank, they went bankrupt. And basically what the narrative was at that point in time is that, yeah, money is fleeing from all these regional banks and it's flowing into Bitcoin. And that's actually what we saw if we were to plot the price action of Bitcoin versus. So let me switch back to trading view here. So right now, what I have plotted here is a graph or a chart of Bitcoin versus KRE, and KRE is the S&P regional banking ETF. And basically, what we saw back in March to April was an incredible price appreciation of Bitcoin against the regional banking ETF. And so essentially what Bitcoin saw was close to, let me zoom in here. Yeah, it's close to a 71% increase in the price of Bitcoin versus the price of the regional banking, all the regional banks, basically. So this is kind of like the narrative that caused the rally in Bitcoin earlier this year from 20,000 all the way to 30,000. And so going back to what I was saying earlier, you have to be aware of certain narratives within this space. So this was one of the narratives, and I still think this could like continue to be a narrative going forward. Now, obviously, the Fed stepped in and they kind of acted as a backstop against all these bank failures, which kind of ruined the whole narrative, unfortunately, if you're a cryptocurrency trader or investor. But nonetheless, I do believe I have to update this study or chart, but I do believe Bitcoin is still up significantly against the S&P regional banking ETF. Uh, so so yeah, that's really what like that was my last point to end this recording with is kind of it's more of like a philosophical question is, could crypto act as a hedge against more global macro risks that we see in the global trading environment? So, yeah, guys, let me know your thoughts. Let me know what you thought of this recording. If you think I can do anything better, or just any kind of feedback that you have, please leave it down below in the comments. Be sure to like and subscribe. And like I said, this is just my first part of a many-part series on cryptocurrency trading. What I'll be doing in the next few segments is really going really going very nerdy and kind of going very, if you're a technical analysis nerd, if you're just a trading nerd, we'll really be geeking out and really diving into some very nuanced metrics and kind of like key indicators within the cryptocurrency space that are very just specific to the cryptocurrency industry that like you just won't have access to if you're trading equities and forex, just because crypto is such a niche and unique industry that you have access to all these different on-chain metrics and all these different on-chain data. So that's what I'll be exploring in future segments. For now, I think I've been going for over 40 minutes, so I'll leave you guys off here. I hope you guys have a great week and safe trading, and I'll see you guys next time.
Hey guys, Jordan here. Just wanted to send you a personal little thank you for sticking around and watching us here at Trade Delicious. If you did enjoy the content, consider subscribing. Everything we do here is completely free. And of course, we have some other video suggestions here which you might love. We will see you in the next video.